Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Matthew Piepenburg, partner of OF Matterhorn Asset Management, the author of Gold Manners and Rig to Fail. Matt, thanks for joining me today.
It's great to be back, Tom. And now we're von Greyerz, even though we operated as Matterhorn. No, it's fine. We operated as Matterhorn for decades, but as an homage to Egon von Greyerz, our founder and managing partner, we've decided to change the name. Nothing else has changed, but the name has changed. Yeah.
So, Matt, how important as a nation or as a world right now is it to understand the reality of the situation that we are in, whether that be from a fiscal, a debt, or even a trust standpoint?
Yeah, I mean, it's as we talked about before we hit record. It's understandable. People see so many pundits and experts, and certainly when you talk to someone in the precious metal space, they're going to talk their book and they're going to have a bias. And I think I'm kind of tired of apologizing that. Try to think of me not even as a gold executive in Switzerland. And again, even before I understood gold and precious metals, I was trading stocks and bonds. So I think it's understandable to question, and you should question. But anyone, whether you're pro or against Bitcoin or pro or against precious metals or bull or bear in the markets or inflation versus deflation or strong dollar versus weak dollar or no debt versus sustainable debt, any way you look at this, I think common sense speaks to these problems pretty easily. The facts haven't changed. We can all have different opinions, but I think if you really look at the facts, which I hope we can do, we get past the selling the book narrative and get into common sense narrative, and more importantly, get into historical narrative. Try to separate the facts from the bias. Clearly, I have a bias, and I keep saying over and over, we all have a bias in our industry, especially at von Greyerz, but we also have conviction. And we could be doing other things. I could be flogging bonds, at a big bank, or I could be running a long-short equity fund. The reason I don't is there's too much risk in all these places. And it's not just the gold bugs that see these risks. Jeremy Grantham, who's a clear, risk asset expert out of Boston, Jeffrey Gundlach, who certainly knows the credit markets, Druckenmuller, Ray Dalio. These are opinions we all share, regardless of our particular expertise, whether it's in real assets or risk assets. You have to be honest with the facts. Everyone can draw their own conclusions. The way I look at it, and I don't think it's just bias anymore. Whether I look at the credit markets, the stock, the equity markets, whether I look at certainly the debt markets globally, nationally, the rate markets, and the currency markets, for God's sakes, not to mention the de-dollarization themes or the COMEX markets, they all point towards currency destruction, not the end of the world reserve currency, just a repricing, not a replacement, a repricing. Debasement, inflation, even though you'll have disinflationary forces, we'll talk about all this. All of these things point to a debt crisis, which also points to an inflation crisis, which inevitably leads to a currency crisis. Again, not the end of the world, not mushroom clouds over the dollar. But if you just look at the facts, clearly you need an alternative to paper money. Mm-hmm. And clearly you need to think about these risks. And it's amazing in all the places I've traveled this year, consensus think is still typical diversification portfolio construction, whether it's very sophisticated family offices or high net worth individuals who are still thinking the next 10 years are going to be like the last 10 years. Now, folks watching you and other good platforms like this are a little bit more questioning, I think, a little bit more eyebrow raising, a little bit less prone to just drink the Kool-Aid, the standard narrative. You don't have to be a kook or a quack, though, to be contrarian intelligently. And if you look at the real facts and stay away from groupthink in an informed way, I think a lot of things we'll talk about today are not crazy. They're not dramatic. They're not sensational. They're right in front of us to see. And I hope we can stick to the facts as much as we can. But of course, you also asked about trust. Trust is openly disintegrating. Trust in the US Treasury, trust in the US dollar, trust in the great American narrative. And I'm still always going to be an American patriot, but America is not what it was 30, 40 years ago, certainly not 60, 70 years ago. So these things aren't meant to be conspiratorial or negative or anti-American. It just is looking at the facts. And if we get into the facts, again, draw your own opinions, but the opinions I'm drawing from these facts and the experience I have in the markets is not only be prepared for what's coming, but what's already happening right now. And as we look in these different silos, these different threads, these different verticals. They're all pretty strange, pretty dark, and not the end of the world, but boy, the next 5 years, the next 5 months are going to be very different, and the last 5 months are already very different. So it's not even projecting; it's right in front of us.
Mm-hmm. Yeah, it seems like we are on this, this treadmill of sorts when it comes to news, when it comes to all of these changes that we're seeing in our world. And I feel like it has desensitized a lot of people to the the ability to understand these steps, these small steps towards this larger change that we're going to look back in hindsight and see that this was a very pivotal time in history. But I wanted to pick up on another thing that you were talking about these family offices that don't necessarily understand this importance of tangible assets, if you want to call them that, or hard assets. Do you think that that is mostly due to recency bias, that many of these asset managers don't look towards gold or these hard money alternatives?
Yeah, look, and again, I was a hedge fund portfolio manager in the dot-com bubble, a lucky idiot, but I was young, but I saw it. I was then a family office managing director and CIO. So I understand that space, not just from some kind of theoretical perspective, but having kind of seen how the sausage is produced there. I think is a couple of ways to look at family offices, because they are full of very smart people, and they're usually run by families that have done something very well, whether that was bulletproof glass, prime brokerage accounts that they set up, or hotels and leisure. These are not stupid people. It's not meant to be condescending. I call it the family office industrial complex. It's a lot like the RIA industrial complex or the banking industrial complex. It's very normal to take the perspectives and the lessons and the context which you came from into your family office space. And most family offices have managing directors or CIOs who were usually pretty high up at some large commercial bank and cut their teeth on a bond desk or on a stock desk or in a private wealth management branch of a big bank. They got MBAs from good schools. They're taught to think about return on investment and risk-adjusted returns. And they're educated in a way on Wall Street where, look, it's a known adage that the bears get fired and bulls get hired. The whole business model of banking and private wealth management is to always be calm and carry on. The Jeremy Siegel model, that look, markets go up and down, bite the stick through the downturns. You'll get, stick it out. They give you an annualized return over time of 8%. You've got to not just be hugging your knees, thinking about risk all the time. The S&P is 70% positive most of the time. In other words, this narrative that just learn to diversify, learn to manage risk in some ways, but ultimately stay the course. And that's not a lie. They're not saying that because they're being nefarious. That's what they believe. That's the Kool-Aid. That's the religion that you're taught in Western, MBAs and Western banks. But again, that narrative worked before we were 35 trillion in public debt, before our debt to GDP crossed the 100%, now into the high 120s, before our deficit to GDP, is 6 to 7%, before we took our public debt from 17 trillion to 34 trillion in a decade, before we had 210 trillion in unfunded liabilities and 190 trillion in assets. In other words, a banana republic balance sheet. So those old narratives that stay the course, stocks and bonds will reward you, bonds are safe haven, stocks are more risk prone, diversify, get through it, it'll be fine, don't panic, don't be cynical, don't be bearish. All that made sense for many decades. It doesn't make sense really post 2008 in particular, when you get to these debt levels, this exponential level of debt. That's where you have to rethink the narrative. And in the West, whether you're at Wharton or Harvard, whatever, Stanford, MBA, whatever you get, and then go into the family office or high-end banking careers, you're not taught about Keynesian economics. You're taught about Keynesian. You're not taught about the Austrian School of Economics. When I'm in Eastern Austria or Vienna, or I'm in Turkey, or even in parts of Germany where that is more known, what does Austrian economics say? Eventually, if you go too far over the Rubicon in debt, and this is true historically and mathematically, again, even Reinhardt and Rogoff in the West know this, but in the East, it's very understood that once you go so far in debt, growth is cut by a third when you cross 100%. And you cannot get out of a debt crisis at this level, even the home of the world reserve currency, even Wall Street, even US, even Goldman Sachs private wealth management, even the smart guys at JP Morgan. When our nation and our bond market is this debt soaked, you cannot avoid currency destruction, currency debasement to monetize that debt. That is not a gold bug case. That is not discussed at the bond desks and the prop desks of the big banks. And I remember 20 years ago, any of us who were trading bonds thought, man, this QE, this artificial support, it can't last, but it'll probably last 50, 55 years. We'll worry about that for the next generation. But 20 plus years later, it's happening now. Mm-hmm. We are at the place where we have to inflate or die to sustain our sovereign bond market. And if you look at the junk bond market or the corporate bond market, again, this isn't a gold bug. Gunleck said it's on the edge of a cliff. Luke Roman calls it blood sport. And even Gunleck says when you look at actual inflation, you have to be stupid to buy most of these bonds. There's no return. So again, this isn't a gold bug trying to say bonds are not safe and stocks are overvalued. Whether you're talking to the best and the brightest in the bond space who are being honest, and whether you're talking to the best and the brightest in the equity space, they're clearly overvalued. They're clearly at blow off tops. They're clearly unsustainable. So you have to think differently. And again, if you understand Austrian economics, not taught at the big MBA programs in the West, you know that when you look at the debt data that I just spit out, which is an abstraction, it's not an abstraction. When you look at that hard debt data, you will see your currency debased, regardless of its relative strength on the DXY. It will get debased. And if you think about what debasement is, it means the purchasing power of your Canadian, Australian, or US dollar is getting weaker every year. And that's when we get into the inflation discussion. But that's an invisible tax. That's a loss of money before you even pay your actual federal or state income taxes. As Rick Rule said, it's not just the inflation rate, which is an open joke. It's your taxes too. When you combine those two things, the average American who isn't in the top 10% or 1% really, really feels this. And that is extremely frustrated. It is a gut punch to the middle class, which many Americans now are just the working poor. You can't say that and say it's sensational anymore. And if you look at the data, it's pretty quantifiable.
Mm-hmm. Well, Matt, we could make the argument that these debt to GDP levels, as you mentioned earlier, have been reached before. If we take the case of after World War II, we were in a similar debt to GDP. But what is different about this time that makes this so much more of obviously it's a pertinent issue, but it just makes it so much more of an acute issue?
Yeah, it's a really important question because a lot of bulls will say, come on, gold guys, we've heard this debt to GDP thing before. It's just an abstraction. Look at Japan. It's in the 280 plus debt to GDP. And America was here before, after the war. And it's important to, break that down at a couple of levels. First, yes, coming out of World War II, after America and Russia, it made massive sacrifices to save Europe from the dangers of fascism, et cetera. But after World War II, despite the debt of that war cost, America was the world's greatest manufacturer and the world's greatest creditor. You fast forward to today, we're the world's biggest offshore of manufacturing, and we're the world's greatest debtor, not creditor. So America is not the same to when you run a debt level now with a public debt at 35 trillion as opposed to under a couple of 10 or 20 billion or hundreds of millions in the 40s. Your availability to use interest rates to protect you from inflation is not quite the same, because when you raise rates at 34, 35 trillion in public debt, your interest expense becomes unpayable. So yes, debt to GDP was higher post-war, but we also had far more manufacturing. We hadn't sent the American dream to be made in China, and we also had a lot more credit as opposed to debt. When you look at Japan, people say, well, look at Japan. Look at its massive debt to GDP ratios. There's a few things to distinguish Japan. First of all, Japan isn't the home of the world reserve currency. That's a key distinction. Also, the vast majority of the JGBs or the government bonds in Japan are held by the people. They're not held by foreigners. So JGBs are held by, the Japanese folks themselves. The other thing is Japan isn't running twin deficits like the US is. And Japan has a positive net international investment position. In other words, it has a piggy bank outside of its borders. That happens to be the S&P mostly. But Japan is not America, so you can't compare them. But ultimately, the same forces that Japan has been using, like QE since 2000, destroying its yen, it's happening faster because it can't export its inflation like the US has been doing for decades. Now, the US is in a Japan-like situation, though, because it's printed so much money and the exporting of its inflation through the forced purchase of the US dollar in the euro dollar markets or in the petrodollar markets, and the forced, the exorbitant privilege of our currency, your problem, and we could just export all our inflation and our monetary policies and let the rest of the world eat that sandwich. Well, that's changing now. So there are so many forces that make this debt to GDP different today and worse today than it was post World War II or comparing it to Japan. We can't get away with exporting inflation anymore. We can't just have other currencies bend to our knees when other countries are actually now going around the US dollar, when oil can be bought outside the US dollar at increasing rates, which we can get into. But it's a very, very different debt playing field today than it was then. So the debt to GDP numbers today are even more dangerous when you really think about it. Again, Volcker could raise rates in the 80s to fight inflation when our public debt was less than 800 billion or 900 billion. But when your public debt is 35 trillion, you can't raise interest rates by 1,000 basis points to fight inflation, because then the interest expense on our IOUs would simply be unpayable. And right now, at the current higher for longer rates that Powell is using, even Bank of America has admitted this, the interest expense alone on US Treasuries is 1.6 trillion. That's twice our military budget. And Neil Ferguson reminds us, when your interest expense is more than your military spending, that's a big red flag. So again, not gold bug arguments, not doom and gloom, not sensational, just hard facts. Now you can draw your own conclusions from those facts and think that's okay. My conclusion is, A, it's not okay now. It hasn't been okay for a couple of years. It's going to be even worse for the next couple of years. It's no longer theoretical. And if you look at the bankruptcies in the middle class or small business in the US at 13-year peaks, 34% higher than it was last year, the number of layoffs, you look at a stock market that was the Magnificent Seven, then the Fabulous Five, now the Triumphant Trio. It just keeps getting more and more narrow, more and more overvalued. You look at a bond market with triple C junk bonds that are going to default at these rates. You look at sovereign bonds that don't give you a positive real yield. Come on, I don't mean to be negative, but no matter how you look at it, these are egregious problems happening in real time, not just for the middle class and the labor markets, which are far more at risk than the Bureau of Labor Statistics would tell you. And besides, labor unemployment's gone from 3.4 to 3.7. That's a lagging indicator. We'll see it go much worse after we're already in a recession. And I think in a lot of ways we can talk about America is in a recession. Germany, China, the UK can admit they're in a recession. We keep pretending we're not because of our markets, our quote labor data, but both of those are hanging by a thread. And again, I'll say the markets can go higher for sure. They can go blow off tops. I've seen that movie before in the dot-com bubble. But if that's the only narrative we have right now is a rising S&P, which is nothing more than a tech ETF, where 20% of the market cap is held in 3 stocks, in the Nasdaq's 50% led by 10 stocks, that is not a healthy equity market. And the bond market is purely on a respirator right now.
Well, Matt, in that vein, what do you think we can learn by looking at the parity or the difference between the junk bond space and the sovereign bond space right now?
Yeah, I mean, look, again, I defer to people who know bonds far better than me. And again, I go to Gundlach you can go to Gross, but Gundlach really is the new bond king. What's interesting is, junk bonds, they can't refi at these higher rates. They can't. And a lot of banks hold junk bonds because investors are going further and further on the risk branch to get a little bit of yield. And the high yield market, they call junk bonds high yield, but you're not getting that much yield on these junk bonds. You're getting very little yield for incredible risk. But at these rates, they can't extend and pretend and refi the way they used to in the 80s or the 90s. And the triple C junk bonds, the spreads between junk and others are getting wider. And a lot of these junk bonds are simply going to default at higher rates. And Gundlach would tell you the banks that hold them, even the too big to fail banks, are doing so at their own risk. what's even scarier than these triple C junk bonds and these bad credits with higher rates, they already have a weak ability to manage their balance sheets. They're not going to be able to pay if we continue to raise rates. They're not going to sustain themselves. But what's even more dangerous in Gundlach's mind, by the way, junk bonds went up in price early this year, just when the Fed was talking about rate cuts. There were no actual rate cuts. Triple C's went up in price, even though their fundamentals were getting worse. That is distortion. Even the carrot of promising a rate cut or these dot plots at the FOMC was enough to buy some time. But even a rate cut, if we have one, and if we do, it'll probably be in September, that's not going to save the junk bond market. But far more nefarious and risky, again, not discussed at the family office management meetings, are these private credit pools that everybody's going into right now, which are really just black boxes of bad loans for the most part. They're not marked to market, but they have capital calls. They're incredible. Those to me are the weapons of mass destruction right now. And again, not just a gold bug. Gundlach would say it more eloquently than me. And he gave the example of Harvard. Its endowment has 60 billion, but Harvard's broke. It's not liquid because its money is in these pools, these credit pools, which are tier 3 assets, which just means the managers of those credit pools aren't marked to market. They can say that this book of loans is worth X. They can say it until they need liquidity or until there's a redemption. But the actual value of those loans that they're making, those private loans, which are collateralized by a lot of crap commercial real estate and other unlovable things, when you actually look at the real fundamental value and price of those quote unquote loans, they're far below the book value in these credit pools. And you see that all over the place. It's down into the right. So you can be rich on paper at Harvard, but you don't really have liquidity. And the values you're looking at, that's just the values the portfolio manager tells you they are until they get audited or until you need liquidity. And again, that sounds sensational, but as Gundlach said, they're a scam. And the SPACs, but what is that? SPACs were good for those that were pushing them and getting a fee, but they're not good for those investing in them. And as Gundlach says, and I agree, a lot of sophisticated families or high net worth individuals who still have that cognitive dissonance that tomorrow will be like yesterday, they trust these smart guys. Everyone else is doing it. And they know that bonds aren't really giving them a good yield when adjusted for inflation. They know the stock market's dangerously narrow and blowing off. So they go into these things they don't know. They don't know what's going behind these private credit pools, but the smart guys are doing it. Harvard's doing it. Stanford's doing it. Must be good. And we've seen this movie before. I've seen this movie before where everybody crowds in and thinks they're safe. Like right before the Nikkei crashed in '89, the big saying, I've said it many times, is in Tokyo was, how can we get hurt if we're all crossing the street at the same time? That is a groupthink that feels good when everyone else is doing it and feels really stupid once the genie's out of the bottle and those successful, sexy credit pools or other groupthink investment ideas turn out to be horrifying. And again, sounds sensational. Look at the real bond jocks, who are the smartest guys in the room, and they'll tell you these credit markets are appalling. They're appalling.
You brought up a phrase there, Matt, that I want to really touch on and kind of dive into. We hear this phrase mark to market. What should we be hearing as investors, when we pick up on that? And does this also present more of a risk to the current paradigm, whether we're applying this to these family offices or, the banking industry or the commercial real estate sector as well?
Well, again, mark to market. Right now, NVIDIA is mark to market. It's supply and demand. It's how much demand there is, how much supply there is, and what the market will pay for it. That's a transparent. You may argue it's a grossly overvalued value, but it is what the market says it is, based on genuine price discovery and genuine supply and demand. And in a case like a publicly traded stock, like Lucent was in the dot-com bubble, or Microsoft was then and now, or certainly in NVIDIA today, you can look at its net income margins. Does it have a profit or does it not? Does it have earnings or does it not? Can you look at its balance sheet? Can you look at its financial statements? Yes, you can. And you can make an awareness based on that fundamentals and then what the market's paying for it. Then you can get a valuation. In a private credit pool or a book of loans that haven't defaulted yet, you can mark them whatever value you say they're worth in the contract. But what are you actually going to get that value for? That's not marked to any market. That's based on hope and expectation. You may have a wonderful house on the side of a river that you think is worth $2 million, but someone may only give you 800,000 for it for a number of different reasons, because there is no supply and demand publicly traded market for houses on a river in a particular zip code. And a lot of these tier 3 assets, or whatever the asset manager says they are, until it's time to actually make a sale and either get a profit or a loss. Right now, they're just in limbo. So there's not a market valuation. You can't ascertain what its real value is. A lot of commercial real estate pools have already shown they're down 5 to 50% this year, because when they did try to sell the assets, they were significantly at a discount from what they were marked at on the books when the actual time to sell came. And that's where the rubber meets the road. That's why private equity and these credit pools may look good on paper when you're getting your statement, but when it actually comes time to value them in a real buy-sell scenario, a real bid-ask scenario, you're going to find like the AT&T Center, I think it was in St. Louis, which was valued at hundreds of millions, and sold for like 10 or something. It was something appalling, and that's an extreme case. But those off the balance sheet kind of unmarked to market valuations are mostly fantasy. I almost call them Madoff valuations. Is what he tells you they are, but it's not what they really are. And again, that sounds sensational. So take away the gold bug from Switzerland and ask Jeffrey Gundlach, ask Jeremy Grantham, ask Kroenthal, smart guys who really know credits. This is not fable, but fact. And it just hasn't hit home yet, because we're still in an extend and pretend, be calm, carry on narrative, certainly into election year, where, if the S&P is breaking all-time highs and the NASDAQ is still churning, we'll be okay. And those private credit pools can refinance, or maybe rates will come down and real estate will be saved. And there's all kinds of bullish scenarios you can make. I just don't believe them. Personally, I don't believe them. And again, I've seen this movie before in prior bubble burst cycles. And what's scary today is we don't have a very good narrative outside of the S&P and the NASDAQ right now. We just don't. So when they do what all markets do, which is mean revert, that'll be very brutal. And like I said at the beginning, you can make the bull case. I don't want to be just bearish. You can make the bull case that we'll cut rates dramatically. We'll provide all kinds of direct or indirect liquidity to these markets. And you could see much higher highs than today. And you could. But the only way to do that would be at the expense of the currency. So if you're making 20% or 25% on a NASDAQ that never dies, well, you're going to be measuring that in wealth and paper money that has lost more than 40% of its inherent purchasing power in the last 5 to 10 years. So you're really getting nothing but a paper return, but the value of your currency is getting weaker. And the only way to sustain these markets is to effectively monetize them with the liquidity or fake money, fiat money. So, of course, that all goes back to gold. And again, it's a lot thrown at you, but it's inflate or die right now to save the bond markets. I mean, Richard Russell did that 20 years ago. He's been absolutely correct. Again, these are not just gold people saying this or precious metal people saying it. I was never a gold bug. Egon von Greyerz was never a gold bug. We came out of banking and markets. We just understood real money versus paper currency. And so, again, doesn't mean 100% of all your assets or family office assets have to go into gold. That's concentration risk. But if you don't understand real money, and the West doesn't, they understand rate of return, but they don't know how to measure that fiat rate of return with common sense. And that does sound condescending and old Swiss buggish, but it really is common sense. Really is.
Matt, when we think about the amount of liquidity that is in these markets, is it all about, just keeping this liquidity flowing at this point? And is that what is, for the most part, supporting these markets at this point?
Yeah, absolutely. I mean, again, I use the analogy of an engine. You could have the best car in the world, but if you don't have oil in the engine, it breaks down. It starts to hiss, smoke, steam, and pull the car to the side of the road. Liquidity is absolutely essential to a healthy or even an unhealthy market. And without that liquidity, the oil comes out of the engine block and the car stalls. People will say, well, look at Powell, man, the markets are still at all-time highs and we're tightening our balance sheet and we're raising rates and we're not providing that kind of liquidity that we did post the great financial crisis. So the machine must be working. And again, on the surface, that's absolutely true. But if you look under the hood a little more carefully, there's tons of liquidity, trillions of liquidity that is really just backdoor QE. It's also inherently inflationary. And again, giving facts, not just drama. okay, we don't have direct QE right now where the Fed literally just goes to the Eccles building, mouse clicks a few zeros to the balance sheet and creates instant cash to buy unwanted IOUs. But what you have had in the last 5 years is all kinds of forms of what I call backdoor liquidity. I mean, we've issued treasuries from the short end of the curve to trillions of dollars. We had the BTFP program where we basically bail out the banks. That's liquidity. We've used the reverse repo markets to provide liquidity to the too big to fail banks. We now have what's called supplementary leverage ratios, which basically just means that the big banks can use unlimited leverage to buy unloved US Treasuries, which is basically QE by commercial banks instead of the Fed. It's just the commercial banks doing what the Fed is supposed to do. You even have Freddie Mac guaranteeing second mortgages. You have new rules at Basel. There are all these indirect forms between the TGA account, reverse repo market, supplementary leverage ratios, all these wonky, fancy Wall Street terms. But all that is just liquidity by another name that's still highly inflationary. It buys time, but eventually the Treasury General Account runs out. Eventually the reverse repo markets needs more funding. Eventually the Fed will have to print more money to pay its interest expenses or default, which I don't think it'll do. I agree with Luke Roman. I take as a case study, a base case, that the Fed won't allow treasuries to default. So they'll have to monetize them with more liquidity, which is coming out of thin air or all these other backdoor programs. So that is inherently an impact on inflation. It is inherently an impact on the dollar. And even Yellen now is openly saying, I mean, the Fed is basically openly saying, I think it was, gosh, who was it? It was Yellen. There was somebody else. I mean, I have to come up with it. I can't remember the name, but they're all basically saying we need a weaker dollar. And as Gulak would say, you've got $8 trillion worth of US Treasuries that foreigners own and 13 trillion in dollar denominated debt. Those foreigners need a weaker dollar to pay for those treasuries. Even the Treasury Department admits they need a weaker dollar. In the meantime, you have all this indirect liquidity that's to the tune of trillions every year. All of that debases your dollar. And again, we also need negative real rates to get out of debt. That means we have to have inflation higher than the yield on the 10-year. I know this sounds wonky, but the Fed actually needs higher inflation. What they do is they just misreport the inflation. There's all these tricks between open lies in the CPI scale and backdoor liquidity that are highly inflationary, which is, again, throughout history, debt-soaked nations, including the world reserve currency in the US, need to debase their currency to monetize their debt markets. And the Fed's real mandate isn't employment and inflation. The Fed's real mandate is to keep US bonds bought by something or someone. And if no one else wants them, they'll print the money or create the liquidity to support that market. And that is always at the expense of the currency, which is really at the expense of the middle class.
So, we talk a lot about currencies, Matt, and it's always brought up that there is a real opposition or a new replacement to the global reserve currency with, this alternative currency system that the BRICS seem to be, again, slowly building progress on. What do you see as, let's say, either the most likely candidate to replace the dollar, and or do you see this as, this gigantic looming instant signpost all of a sudden that ends the hegemony of the US dollar? Or are all of these currencies in a way in the same boat against hard assets?
Yeah, let's be real clear. Even with when there was a couple years ago when everyone was all galvanic about a BRICS new currency, gold-backed currency, I was rightfully at that time. I'm not right on everything. I've been wrong on a lot of things, but I knew that wasn't going to happen. It doesn't need to happen. It's certainly, and I'll explain why, but to your first question, no, the ruble and the yuan or the real or the rupee or the peso or the British pound sterling is not going to replace the US dollar as world reserve currency. There is going to be no new currency. There could be central bank digital currencies and some IMF reset, but the dollar will still be the world reserve currency, in my opinion. What is definitely changed is not that the dollar will be replaced, it's being repriced. And that as a reserve asset, the US 10-year Treasury or the US sovereign bonds are openly and not gold-buggingly sensationally currently and in the last many years being replaced by physical gold. And again, you can show the charts. Since 2014, central banks, in particular in the East, have been net selling US Treasuries, which they don't want and don't trust, and net buying over 1,000 tons a year in physical gold. That, again, isn't a gold bug argument. It's watch what the central banks are doing, not what they're saying. And if central banks are buying gold and dumping US Treasuries, that's because they're using gold as a savings instrument and the dollar or other fiat money as a liquidity instrument. And that's exactly what our clients do. And to make sense of that, again, you save in gold now, not just as individual families. If I have X amount of ounces and grams of gold as my savings account as opposed to fiat money, if I need liquidity to buy a house or to pay for my daughter's wedding, I can sell some gold and convert it into dollars to get liquidity to pay for the wedding. But I save and store my money in gold because it holds its purchasing power far better than a US dollar or a US Treasury by extension. And again, just so this doesn't look like a gold bug case, keep it simple, stupid. Think about a simple example. I've said this to family offices, and I've said this to high net worth investors who are smart in a lot of ways, whether it's in medicine or cattle or mining, but they don't understand, they don't understand money, and they think they do. So you have to keep it simple, stupid. Again, not meant to be condescending. And you can argue, well, there's gold consolidates and goes down, but it's really trending up. But pick your statistical window, Matt. You're just going to tell me what I want to hear. But no, think simple, stupid. If in 1920, and I use this example over and over, if in 1920 you wanted to buy a house in America, the average home price in America was $5,000. And in 1920, an ounce of gold was $20 an ounce. So if you wanted to buy a house, you could either take $5,000 in dollar bills or $20 bills or $100 bills, put it in a shoebox, walk over to the realtor and buy the house. Mm-hmm. Or you could have had 250 1-ounce coins, little bars of gold. And at $20 an ounce, those 250 1-ounce bars would also buy you a $5,000 house. Now, if you fast forward to 2024, over a century later, the average American house is now $500,000. Now, if you took that same shoebox of cash from 1920, nice old $20 bills from 1920 or $100 bills, that wouldn't buy you a house today. But if you had that same shoebox of 250 1-ounce coins or ounce of bars of gold, that would buy you a house. And my point is, gold significantly stores value better than fiat paper money. What would you rather save your money in since 1920? Those dollar bills or those little gold ounces? Mm-hmm. And again, that's how you have to understand it. And you say, well, Matt, gold went down for a certain period. Yes, of course, gold doesn't go in a straight line. But generationally, legacy, insurance-wise, for dying paper money, it's a no-brainer. Mm-hmm. And it'll be the same 50 years from now, 60 years from now, 100 years from now. You cannot save and store value in US dollars or US Treasuries anymore, especially when we're this in debt, especially when our currency is this debased. And again, doesn't mean the only thing you should invest in is gold, but if you're trying to save generationally, you have to have gold. And then people say, well, insurance is boring, but even as a second optionality for just pure, and I hate to say it, even pure speculation, gold has significantly outperformed the S&P, even this crazy S&P since the turn of the century. And again, people could argue, yeah, but Matt, that's just one statistical window. And they're right. Because I don't really look at gold as optionality for speculation. But ironically, even with the biggest bubble I've ever seen since 2000, gold has outperformed the S&P total return. That means reinvesting dividends. So if gold is outperforming the stock market and it holds value more than any paper money, including the US dollar, why aren't family offices at least putting more than 0.5% or 1% of their allocations into gold? It boggles the mind. But again, it's because gold is deliberately misunderstood. We can talk about why, but again, it just isn't a gold bug argument. It's common sense. And the more you understand this, and the more you get less cynical and say, oh, you're just using particular statistical windows or different averages. No, look at a century, look at 50 years, look at 60 years, look at over a century. There is no paper money that retains its value, and gold just does. Why would you measure your wealth in fiat money? And that's why, again, central banks all over the East are now storing gold as a tier one. Let's remind BIS, it's a tier one asset. It holds its value more than a US Treasury. And again, if you look at the TLT, which is the index for the US Treasuries, whether you're looking at gold to TLT or the S&P to TLT or Bitcoin to TLT, everything is outperforming the sovereign IOU of the US government, which was supposed to be the risk-free return. But in the current inflation, which is only going to get worse, It's not risk-free return. It's totally return-free risk. And that is why central banks are dumping the US Treasury and storing gold. So if you step aside, and I'll finish my soliloquy in a minute, if you step aside from all the gold bug sensationalism, all the pundits, look at what the central banks are doing and ask yourself why. Mm-hmm. Why is Saudi Arabia and the United Arab Emirates this year at all-time gold exports out of Switzerland into their country? They're still pegged to the US dollar. They're still selling gold or oil in US dollars. But why are these countries stacking gold? Why are the BRICS in general going around the US dollar? Why are they holding gold? To your question, the US dollar will still be a liquidity asset. It'll still be FX reserves. It'll still be part of trade. But more than 45 countries right now are simply trading outside of the dollar. Mm-hmm. And if Russia wants to sell oil to China, China will give them yuan. Russia will take that yuan and buy a bunch of Chinese goods, which used to be made in America. And then whatever the difference is, they'll net settle that in gold. And Russia's not the only country doing that. All the BRICS countries are doing it, and the BRICS membership is getting bigger. So there is just a quantifiable case of central banks buying more gold, BRICS nations net settling in gold, not a new currency. Gold is the currency they trust. They may settle in rupees, reals, yen, yuan, but they're going to net settle in gold because they may not even trust each other, but they'll always trust gold. And again, this is happening in real time right now. Doesn't mean the end of the dollar, doesn't mean the dollar disappears. It just means there's more and more demand for gold than there is for American IOUs. There's less and less demand for the dollar, but there's more and more supply of the dollar and more supply of the US Treasury. What does that mean? Anyone who took high school economics knows this is not gold bug case. You've got more supply and less demand. It's a devalued currency. And that is why central banks and the BRICS countries would rather have gold to net settle their trades than the US dollar. And they'll just go around the US dollar. I call it the Maginot Line. They're not going to attack the Maginot Line. The Germans went around the Maginot Line. They went through the Ardennes. And the BRICS countries aren't going to attack the Fed. They're not going to replace the dollar with the yuan or the ruble. They're just going to go around it and net settle in gold. Mm-hmm. That is not fable, but fact. That is happening at an exponential rate right now. It doesn't mean the end of the dollar. It just means a very different dollar.
Mm-hmm. You know, it's interesting to try to square discussions like this with other data points, right? And I asked this question when I spoke to Danielle DiMartino Booth last week. And the statistic that was brought up was something like before the pandemic, there was something like 18% of global trade was done in dollars, and now it's 30%. So how do we try to understand that data point, number one? And is it possible that that is an artifact of how that data is collected? If, let's say, countries are trying to actively get rid of dollars, therefore that use of that tool or that liquidity instrument is going up.
Well, this is really important. And again, I said at the beginning, I want to try and give two cases for everything, right? And so people can draw their own conclusions. And I've had conversations many times and publicly with Brent Johnson, and he is of the unlike Gundlach or Groman or myself, he is of the strong and very intelligent school, to your point, that people are still going to use the US dollar. Mm-hmm. And as the rebel capitalist said, I've just been to Argentina. They're not storing gold. They're using US dollars for liquidity and for savings. It's certainly better than the Argentinian peso. So you can make the argument, and we should make the argument, you can make the argument that the facts actually show that the US dollar, no matter how debased, how sinful it is, no matter how much exporting of inflation the Fed has done and the US government has done to the rest of the world, that US dollar is still king. And there's still countries that are still going to use it more than they're going to use gold. And they're still going to do trades in dollars. They're still going to use it as 85% of the FX reserves throughout the world. It's still part of the SWIFT system. And you know what? There's absolute truth to that. What I'm saying, what I'm arguing is despite that, and before I even say despite that, to that point is the dollar is still very important. And by the way, the euro dollar markets, the derivative markets, they all need US Treasuries and US dollars. So there's this massive, milkshake sucking straw demanding dollars there. That should be good for the dollar. And those are the cases, whether it's the milkshake theory and euro dollar and derivative demand, and whether it's the theory of just the SWIFT accounts and as it's a trade settlement currency, it's king for liquidity, the dollar's not going to die. And I actually agree. And the other case that you could make, and Brent Johnson may be proven right, that when the X really hits the fan in the next few years and countries really go broke, where will they run to? what currency will they feel safe in? And if you listen to a lot of experts, they'll say, well, it's still the US dollar. Mm-hmm. And there is absolutely common sense arguments to be made in favor of that, which I don't think we should laugh at. What I will say, though, and I agree with Gunlach, the dollar will be relatively stronger than other currencies. And for that reason, there will always be demand for it, but it'll still be inherently weaker. That the DXY will probably stay range bound because in a recession will devalue the dollar. The DXY will stay between 100 and 108. And I could be wrong. He could be wrong. We could be wrong. Mm-hmm. Brent Johnson sees the DXY at 150. I don't, but he could be right. The reason I don't see that are a number of reasons. That even in a crisis and the world goes to the dollar, even if it is the strongest horse in the glue factory, it's still a very sick horse. And even if it is relatively stronger, it will still buy me less. Even if there's massive demand in a crisis, it will still buy me less than gold. I just know that much. Mm-hmm. And I also know that even if the dollar is in strong demand by the rest of the world, that the US Treasury is not. The US IOU is not in demand, even in a crisis. Now, Brent Johnson may argue, but wait till there's a real crisis. You'll see US Treasuries being bought up. And he could be right. My argument is, no, that won't happen. It's already not happening. It's been net selling since 2014, even in a crisis, even when we raised rates, there was less demand for bonds everywhere. But my argument is going to be, and I could be wrong, and that's why people should make their own opinions, but I think even in a crisis, the Fed will need to create more liquidity because the Fed will need to issue trillions more in IOUs to cover a recession, to cover themselves. Even with the world demanding that US Treasury, there won't be enough foreign demand to fill the gap, and that we will debase our US dollar by printing more of them to buy our own bonds to keep yields in control. That's my view. That's what I would do if I was a central banker and I was afraid to admit that I was broke and I was afraid to admit that tax receipts aren't going to be enough and the GDP isn't going to be enough. If it's not enough now and we have to print money, imagine what it'll be in a recession when we're fiscal spending to the moon and we don't have enough income. We don't have any real buyers of our US Treasuries. Even in a crisis, we will print money out of thin air to buy our own bonds. That will be inflationary. That will debase the value of the US dollar, even if it is still the sexiest trade settlement currency in the world, even if it remains the sexiest trade settlement in the world. All I'm saying is, I don't think it'll send the DXY to 150 or 140. I think there'll be too many counteracts against it to make it weaker just by the amount of money creation, synthetic liquidity needed to cover our own bond markets. I also think that the de-dollarization headline, which was sensational 2 years ago, is happening very fast. And I also think the fact that 20% of global oil sales last year were outside of the dollar and net settled in gold, all of these things to me point to a relatively stronger dollar, but an inherently weaker dollar. And so I don't think the dollar will still be the asset, or the U.S. Treasury will still be the world reserve asset. I think it'll be a liquidity asset. Again, controversial? Not really. Again, I'm not alone in this. I am a gold bug, but even the great bond thinkers feel the same way. Luke Groman, he feels the same way. And I think people will save more in gold than in U.S. Treasuries and U.S. dollars. They'll just spend in U.S. dollars, which is what I do with my gold. I save in gold and I spend in dollars or Swiss francs or euros or whatever currency I need wherever I am. Mm-hmm. But I certainly wouldn't save it in a checking account in a currency that's getting weaker by the minute.
Yeah, I think that's probably one of the best ways to put it, is that gold should be your savings account, not thought of as the checking account. Yeah. And there's another piece to that I'd like to get to. But first, you mentioned this deliberate misunderstanding of gold. What do you mean by that? Who gains from it? And why is there, let's say, an effort to cause that misunderstanding?
So let's because it's really important. Again, just take the last 24 years. Gold has outperformed the S&P. It's certainly held its value more than the US dollar. And it is infinitely a better reserve asset than the US Treasury. And yet no one on Wall Street talks about it. No one in the family offices allocates. Remember, 1% allocation by family offices, the smartest guys in the room, 1% allocation to gold. Why? Because it's a barbarous relic when it's outperformed all other asset classes. Now, at least risk assets. So you got to ask, well, that can't just be a coincidence. 25 years of outperformance and still no one touches it. Couple of things. And again, Eastern Austrian economists and Eastern investors that I talk to see through this, but the West doesn't. And I think, A, because they're not educated to think that way. But I also will argue it's a deliberately misunderstood asset. Because if you're a banker at JP Morgan or Morgan Stanley or Wells Fargo or Goldman Sachs and you work in the private wealth management office, or frankly, even if you work as the CFO or the COO of a major bank, you can't make money in gold. That's the first thing. Gold storage isn't leverageable. It isn't hypothecatable. It isn't the same kind of money maker that it is if you want to leverage bonds and stocks and, fractional reserve banking. Gold is not profitable, so it's not discussed. It really isn't. It's not big money in charging fees for the big banks. The only banks that lever gold are the LBMA and COMEX banks, just to keep the price artificially short. But as a profit center, gold is a no-go for banks. They want far bigger 10x returns on leverage at your expense, at your risk. So A, it's not even good for their business. B, politically, gold is the most embarrassing thing to a country that's in debt. And that is why the moment that we got off the gold reserve, the gold-backed currency in the early 70s and 71, that, Kissinger and Burns and Volcker later, what was their biggest concern when they came into the FOMC or when they came into the Eccles building every day? What's the gold price? What's the gold price? Because if the gold price goes too high, that means the US dollar is embarrassed. It means the US dollar isn't trusted. There's no incentive to talk about gold in the West. Politically, it's an extremely embarrassing, toxic topic for a country that's in debt. Now, I'm sorry, it's not a conspiracy theory, but Washington, D.C. and the Federal Reserve are tied at the hip to the two big to fail banks. It's the mother bank, the Fed, and the little baby banks are the too big to fail banks. They live off each other. They make policies together. They even think portfolios together. And it's my strong opinion that gold is not good for business for the U.S. government. It's not good probably for the banks, so it's not discussed. They don't want massive demand for gold. Now, that may be a conspiracy theory, but it doesn't change the fact that if I'm a wealthy person, I don't care what my banker at Goldman Sachs tells me. I want to figure out gold on my own. They have no incentive to teach you this, which explains why, despite its massive outperformance of the S&P, its massive outperformance of US Treasuries, no one holds it, because it's criticized as a gold bug conspiracy theory about the end of the world. I was talking to someone in Scotland a couple of weeks ago, a very wealthy guy, and we went to his private wealth manager in Dallas. He said, gold. The guy laughed at him. Gold. It's so condescending. It's so ignorant. And look, I didn't grow up in my mother's basement doing Google searches to understand gold. I was a hedge fund manager. I worked in banks. I ran a family office. I understand gold. I don't laugh at it. Doesn't mean it's the only thing you should own. Doesn't mean speculation doesn't have its place. But the fact that these RIA industrial complex banking private wealth managers laugh at gold is an insult to the person they're across the table from. That's not being a fiduciary. That's being a salesman for your industry. And again, I don't think they're evil. They just don't understand it. And they don't want to understand it. And I really do believe that. It boggles my mind why people don't own more gold. What also boggles my mind is the number of bankers who are clients who own a lot of gold privately, but not in their bank accounts or not where they work, or the number of hedge fund managers I know who own a lot of gold, but don't trade it on their accounts. So there's what they say and what they do. Obviously, I'm not going to disclose who they are. It would be shocking who they are. But the smart money, even though they peddle risk assets and credit pools, private credit pools and private equity, when they make their money, including a lot of Bitcoin millionaires, they convert it to gold to store their value. Again, I'm not saying gold's the only thing. I'm not saying if you want to take some risk on high yield credits or junk bonds, or you want to speculate on NVIDIA, or you want to speculate on Bitcoin, which is just a triple Q 3x lever. To me, and I have a lot of respect for the narrative of Bitcoin. I still think it's a speculation asset. People will be pissed off when I say that, but that's what I think. But I have nothing against speculating. I made money in the dot-com bubble by speculating more than I deserved, but I preserve outside of those markets. So I'm not saying that gold is the cure-all and be-all and the only thing people should understand, but the fact that so few understand it and the fact that there's so much time spent attacking it makes no sense to me when I look at the way it's behaved, not just in the last 24 years, but in the last 100 years, the last 300 years, the last 5,000 years. And so, again, it sounds like a rant of a gold bug, but again, I ran a private equity fund, a hedge fund during the dot-com bubble. I made money I didn't deserve on risk assets. I traded a lot of bonds. I have nothing against those, but the way I look at them is no different than Jeremy Grantham or Jeffrey Gundlach today. I get no confidence in those risk asset markets, and I certainly don't want my money in a private equity pool that I can't transparently understand its value. And far worse, a credit pool, which is just bad loans tapped in a nice bow. So I will get back into the markets when they mean revert. I will get back into bonds when there's a discount that I can afford to take risk on. I will not chase these tops. And I will not say gold's the only thing that you should own. But my gosh, the fact that it's so grossly misunderstood, and I'll close with one other thing. The global allocation to gold is about 0.5% because of the opportunity cost in chasing tech stocks. Mm-hmm. But the 40-year mean for gold is 2%. And I believe in mean reversion. Mean reversion in the stock market means it's going to come down by 60%. And again, Grantham at GMO says the same thing. The Elliott's, Singer, same thing. It's not just me. That's the smartest guys in the equity room who see a mean reversion. But I think gold will revert to its mean of 2% allocation. That means a 4x increase in price today just on mean reversion, notwithstanding all the other fundamentals and all the other reasons gold is going to go up, whether it's the petrodollar, de-dollarization, central bank purchasing. I could go on and on. But just on mean reversion alone, gold is going to go up. So, but that's as a speculation price point. But get past the speculation, I just know it's going to hold its value a hell of a lot better than a Canadian, Australian dollar or a US dollar or a peso or a yuan or a yen or a euro or even a Swiss franc. So I don't know why that isn't axiomatic, but to your question, the banking industrial complex doesn't want you to understand that. And that may sound dramatic. Believe me, I come from banks. My daughter was at Goldman Sachs for 5 years. I prime brokered through B of A and Goldman and JP Morgan. I know the banking world. Egon von Greyerz spent many years as a Swiss banker. We have a partner now who spent 20 plus years at Morgan Stanley and Solomon. It's not that we don't understand banks. We do. We don't hate them. They're not all evil. But I'm telling you, they're not fiduciaries right now. And the fact that we're not talking about gold is because they don't want you to know about gold. It's not profitable to them, and it's not good for business in DC. And that's the reason most people don't touch or talk about gold.
Well, when we're considering, let's say the bank's behavior or this aversion to gold for the banks, Matt, has this, kind of this base layer or this effect of driving everybody into these riskier assets, has this all been caused by this, basically lowering, if not zero interest rate regime of the last 40 years that really forces people, up the risk ladder, which also in turn is making them search for yield, which they have to be accepting of the risk that ends up coming along with that.
Mm-hmm. Yeah, look, there's no incentive by our banks or our central banks or our federal government to save money. When inflation is eating away at every day, that's just reported inflation. Even Larry Summers said you use the pre-1983 housing metrics, real inflation today is 18%. Larry Summers is hardly a friend of the common man. But so why would you save at 4%, 2%, or 3% at any bank when inflation's 8% or 18%? Or shadow stats 9%, you're losing money. That forces you to take more risk. That forces you into Wall Street. Wall Street forces you into the markets. Markets give you capital gains. Capital gains gives the government money. It's almost a national interest right now to be in the markets, to look for yield. It's a national interest to go further and further on the risk branch. Freddie Mac will now guarantee you a second mortgage so you can go out and buy another jet ski or flat screen TV and go deeper into debt. The really dark side of the pundit world said that's an intentional desire to make you a slave. I don't know if it's that dark. Some would argue that it is, to make you a debt serf to the banks and the government so that you keep going on to debt, you keep being dependent on their narrative. But regardless of that darker narrative, there's certainly a governmental and a banking self-interest in getting you out of your savings and getting that money into the system and keeping it churning and keeping the markets going and keeping you greater and greater into debt and not a saver. And so, yes, it's forcing investors further and further up that risk ladder. It's forcing even Harvard University to go on the risk branch in junk bonds or private credit pools when they don't have any liquid money, when they can't pay their bills. And that's Harvard. So imagine other universities, imagine. And so imagine your average guy in the street or even your average dentist or even brain surgeon who has a decent amount of money but isn't Bill Gates. They're just being told what to do by Goldman Sachs and Wells Fargo in Dallas or in New York or in San Francisco. We've got a really good Roman numeral 16 private equity fund here that's going to give you great returns. And this is how we did 10 years ago. This is how we're going to do the next 10 years. They're not telling you that the collateral behind those loans or private equity deals are absolutely crap and overvalued. And again, that's not a conspiracy theory. I've looked at those balance sheets. They're horrifying. Gundlach has looked at them. far closer than me. So you have to ask yourself, that guy who went to Stanford with the MBA, he's got to be bullish. He works for a bank. He works for a fund. He needs your fees. Of course, he's not going to tell you about the risk, not because he's necessarily evil, because it's not good for business. And for years and years and years, that can work. In a bull market, everyone looks smart. When the Fed is printing trillions, everyone looks smart. They're not in the business of projecting risk. They're not in the business of telling you what could be wrong with this. And again, when I was in a family office allocating lots of money to alternative investments, the only ones I ever invested in were the portfolio managers who started the conversation by telling me what the risks were, who answered me directly about the collateral. Those are the few and far between. And that's true of every profession. 20% are better than the other 80% combined, but you got to find them. Most of the smart money who made their money outside of the markets trust these guys, not because they're stupid and not because those guys are all used car salesmen, but they're just doing what they have to do. They're selling you a narrative they may believe in, but they haven't done the deeper dive. And if they haven't done the deeper dive, those who invest in them are going to be up for a rude awakening. And that sounds like I'm being gloom and doomish. I'm not. Keep the gold out of the side. This is from my hat as a former hedge fund manager and a former family office director who had lots of money to allocate to the smartest guys in the room. And it was very hard to do, because it's very hard to find guys that will be direct and blunt and show risk and who actually manage risk. Banks are in the business of managing risk. They're in the business of leverage and rate of return. And it gets harder to do that when the country's in debt, when bonds have less value, when equities are narrow. I've never seen a macro environment this horrific, and yet a stock market this high based on such a small handful of names. It really is a setup for something we'll read about 20 years from now and think, wow, how did we get there? It's, again, I can't help but get a little, passionate about this because it's so obvious to me. Really is. And, I could be wrong. We could see disinflation. Absolutely. When you raise rates from 0 to 5.75%, that's disinflationary. If the markets crash, we go into a real recession, that's absolutely deflationary. But and if the Fed cuts rates or raises rates, it's still going to be, at the end of the day, it's still going to be an inflationary environment. That much I know. The currency will be debased. That doesn't mean inflation only going to happen only in one direction. We could see massive disinflation or deflation. But the fiscal reality is we're going to debase our currency, which means if you're saving in paper money, boy, you may think you're making money, but $1 million, that's a lot of money, isn't what it was 10 years ago, 20 years ago, 30 years ago. It empirically is not. You've got to think about that. Doesn't mean everything has to go into gold, but my God, how can you not see that?
Well, Matt, at this point, we've talked about, physical gold quite a bit. You mentioned the phrase optionality for speculation. So how do you see, or what instruments do you see as serving that purpose? And maybe explain what you mean a little bit by optionality for speculation.
Yeah, the optionality of gold as opposed to a risk preservation asset. At VON GREYERZ, we've talked for decades about one thing. Gold is life insurance for dying currencies. Gold preserves its value more than any fiat money. Gold is insurance for dying money. That is our mantra. It always will be. The other argument that can be made, as I talked about earlier, though, is in addition to being really good insurance for dying currency and a wealth preservation asset, you could make the argument that it has outperformed the S&P for the last 20 plus years. It's going to do more in the next 10 years than probably the NASDAQ and the S&P combined. So why not just look at gold as a speculation asset? Because even if it reverts to its mean of 4% or 2% allocations, it's going to go up. So you can just use gold as a speculation asset and a preservation asset. The case can be made for that. And in that case, you could use gold ETFs to speculate, or silver ETFs to speculate, or even physical gold to speculate. For me, that's not the reason we own it. That's not the reason most of our clients own physical gold. We also think that ETF gold is just, if you buy gold to avoid banking risk, well, ETF gold has intermediaries that are footprints of gold, banks are all over that, fingerprints are all over it. So we don't believe in paper gold and ETF gold. It's great for speculating, though. It's great for liquidity, but there is tremendous counterparty risk, even in GLD or PHYS or FIZ. But yes, to answer your question, as a speculation asset, you could make the case that gold will go up. So just buy at 2,400 and sell at 4,200. But as we argue, and it's not just because of our personal interest in keeping you under our umbrella, you invest in gold, you don't sell it. And Brent Johnson made a comment the other day, well, why would you own Bitcoin or gold if you're never going to sell it? Well, I think he's right and wrong. Again, I save in gold. Of course, I'm going to sell some when I need liquidity to buy a car, a house, a wedding, whatever. Of course, I'm going to sell, but I'm never going to sell at a high, just get out of the position. If you understand why you own gold as a reserve asset, like the BRICS countries are doing, like the central banks are doing, everyone but the Fed, why China and Russia are stacking. You don't have to like China or Russia. I don't want to live in St. Petersburg or Shanghai. I don't want to be in that part of the world, but they certainly understand money better than the West. So again, you can speculate, buy gold at 1800, buy gold like Egon did. Egon bought gold at 300, 250. He doesn't sell it just because it's at 24. He holds it. When he needs money to buy something, he'll liquidate it into a Swiss franc or a euro and buy something big. But no, you don't sell gold. You stack it. And then when you need liquidity, you go to the fiat currency nearest to you at the best valuation. And again, go back to that shoebox. You don't store in those dollar bills because 100 years later, they're worth nothing. But if you stored in those gold ounces, they're still worth something. But yeah, speculate on gold, you can, and people should. But it's interesting. People are selling gold now because it's at all-time highs. Man, it's just chapter 2. It's the third inning for gold. By mean reversion, again, by central bank stacking, by gold net settlements and international trade becoming more and more obvious. Again, if you see central banks buying gold at record highs, you got to ask why. They're not speculating. They're getting ready to do more and more trades outside of the US dollar. That means there's going to be less demand for that dollar. My case is, it's very simple. If you see an army crossing the Potomac in the Civil War, it's because they're coming to Gettysburg. Get ready. Get ready for that. That's all. Be prepared. Don't be naive. They're not coming to go to a tea party. They're not coming for biscuits and tea. They're coming to go to battle. And we have a currency battle right now. And the world is clearly stacking arms in physical gold and letting go of US Treasuries and US dollars. Again, the dollar will not be replaced. It's just being repriced. It's being repriced every day. It's been being repriced since 1971. It's lost more than 95% of its purchasing power measured against gold. It's not a gold bug fact. It's a fact. The fact that, Goldman Sachs can't tell that to their PWM clients is appalling to me.
But, you mentioned, Matt, that gold isn't the only thing that you want to put in your portfolio. So I guess what I was getting at is what else is in your portfolio? Let's say, do you want to look at silver or maybe palladium or something like that? And what gives you that optionality for speculation, that higher upside than just the savings account?
Well, look, silver and mining stocks and junior miners and Rick Rule, by the way, would know a heck of a lot more about this than me, and Ross Beatty and a lot of other guys. Certainly, Frank Schuster would know more about that than me because I'm just pretty much physical gold and silver. But these mining stocks and silver is certainly undervalued compared to gold right now. And as we've seen in prior cases where gold rips, these other silver in particular and these other stocks, these other equities rip even higher. You get more velocity. And as Egon says, though, silver and mining is not for widows and orphans. I think the gold silver ratio is going to be compressed dramatically as gold starts getting even more momentum behind it. And it doesn't mean gold goes in a straight line. A lot will speculate, quote unquote, in silver, for example, because they're going to get more juice out of that when silver rips. I mean, 70% of the silver supply has been drained off of the London exchange in the last 18 months. There's a supply and demand mismatch with silver. I remember watching the CDS trade during the 2008 crisis when mortgages were defaulting. The ABX, the real estate index was going up, and yet mortgages were defaulting. I see right now gold hitting all-time highs, and silver still can't really stay above 30 long, but I think it's going to go well above 50 at some point. I'm patient, as Rick Rule says, because I think silver will reward extravagantly but infrequently. As an investor, I think 10 years out, 5 years out, not 1 quarter, 2 quarters out. But I think those are going to be great return assets for the patient investor, for the day trader, for the high frequency trader, for the week to week momentum speculator. There's going to be much more upside in NVIDIA or even certain other stocks, although lately that hasn't been the case, or other SPACs or risk assets where you think you'll get out in time. Again, I'm not here to mock anyone who's speculating. I was a speculator, but when I was a speculator, the dot-com bubble, I bought cheap. You could get Netflix, Amazon, and you could get those at single-digit valuations. That was just the luck of my generation. So when you ask what's in my portfolio, well, right now, why would I chase the top? I don't have FOMO. I have preservation.
Mhm.
For those who have FOMO or those who are waiting for an opportunity, that's fine. But do what your dad and grandfather and everyone has taught you, but no one does: buy low and sell high. Why would you chase a top, even if it's not the top, even if it can go 20% higher? Wait for mean reversion and buy at a bottom, like Jeremy Grantham and singers are doing at Elliott or other hedge fund managers I know. Of course, they're still in the game. A lot of them are holding in short-term treasuries to get a little bit of yield.
Mhm.
I wait for that mean reversion. The flip side of that argument is, well, Matt, what if the markets never mean revert because the Fed just keeps printing more money and they just keep going up and to the right? There is the case to be made that markets are now beyond correction, that there's never going to be a downturn. I find that plausible, but nearly impossible to imagine. It's hard to see when markets are ripping. Look at the dot-com bubble, look at the '08 bubble, and look at the current bubble. Look at the valuations. I mean, when I thought the dot-com couldn't get any higher, and then we had the 2007, 2006, 2008 bubble, and then you look at what happened after, and you look where our bubble is today, it's nosebleed territory. It's terrifyingly overvalued. Again, Grantham says grotesquely, astonishingly overvalued. And this is a guy who spent decades looking at balance sheets, financial statements, technical charts, and analysis. So this is not me being doom and gloom to say, get out of stocks and buy gold. Look at what the other smart guys in the room on these, who are experts in these areas, say. So to your question, what would I be in? Well, I'll definitely be back in the NASDAQ and the S&P when I can get a fairer price. And I will never time the bottom correctly. I'll be near the bottom. But again, I don't want a market that's led by 3 names or 5 names. And I know that the price, volume, and these net income margins that are enjoyed right now by the top 3 stocks aren't sustainable forever. I've seen this movie before with Lucent. Now I'm seeing NVIDIA. They're not bad companies. They're overvalued companies. I've seen what the yield curve does and then doesn't do just before market tumbles. You don't need to be a genius. Just watch the net incomes. The net income margins on these top 5 names. And when they start to roll over and sustainably lose profit, and when they sustainably lose earnings, that's when you're going to get your short signal on these names. And I've shorted Amazon. I've shorted Tesla many times. Tesla was once unbreakable. I knew a guy in Morgan Stanley, all he did was go long and short Tesla because of the volatility. If you're not someone who can do that, if that's not your day job, be very, very careful. And I tell my daughter, my son, who are in their 20s, late 20s, you're young enough, you can just wait for blood in the streets with Baron Rothschild, who I'm not a big fan of either. As he said, wait for blood in the streets. That's not sexy right now when you can get X% a month on a tech stock. But look, I think the AI meme was just like the .com meme. It was just like the real estate meme. It suckers the plankton into the Wall Street whale's mouth. It gets the FOMO trade going. It gets the trends going. And then it massacres about 80% of the people who got suckered into that.
Mhm. Yeah, I mean, as you're explaining that, it just, these equity valuations just in my mind, as you're again explaining it, just equal risk. And I think as investors, not necessarily speculators, but we can all wear multiple hats, and we should. The ideal is to be able to remove as much risk as possible. So again, to your exact point earlier, we can look over certain data points or certain time periods and cherry pick, if you will, some of this data. But at the end of the day, ideally, you want to remove as much risk as possible. And I think you distinctly made the case for gold being a real cornerstone of that type of looking at value and wealth preservation.
Look, and again, yes, the Shiller S&P right now, the PE ratio right now in the S&P is what, 33, 34. That's still not as high as the .com. It can be higher. Mm-hmm. But I think the S&P is now trading at 7.5 times the global equity index. It's just so overvalued compared to the rest of the world. Mm-hmm. And that's another dangerous thing. Unlike '08 or even the .com bubble in 2000, where you had a tech crisis in 2000, a real estate mortgage-backed security crisis in 2008. Now you've got, again, Germany, the UK, Japan, China in recession, Germany in a recession, okay? So when this bubble pops, when these PE multiples become real, and when we have mean reversion, unless we print to infinity and get the market up just on a debased currency, which is a lose-lose, but when these markets revert, there's no good narrative left, not just in the US. You have global dysfunction. In the '08 crisis, Australia didn't suffer as bad as the US because there were still things happening in China with their trade, or Europe didn't suffer as bad. But now, this is it. This is the last bubble. We've had bubbles in Moderna. We've had IPO bubbles recently, Peloton bubbles. We've had Coinbase bubbles. We've had Bitcoin bubbles. Well, now we have the last bubble. It's these pathetically narrow little names. And again, ask any true value investor on the S&P, the NASDAQ, or the Dow, what's a good name out there or who's profitable? It's not me being gold bug negative. This is true. And so when this bubble pops, despite how much liquidity they can put into it, what's going to be the narrative then? Well, we can blame it on Putin or COVID or global warming, but it'll just be a grossly overvalued market bubble. Mm-hmm. And so I think it's a very dangerous time to be chasing. And by the way, look at Bezos. What is he doing? What are all the big CEOs doing? They're selling their stocks behind the scenes. They're getting out. They always do. The plankton comes in and the big guys get out. And if again, I wrote a paper the other day about this generation. Man, it's appalling. I mean, I've seen greed. I saw it in the dot-com bubble. I was greedy. I was stupid. I made investments in films and stupid things. But man, there's nothing like America today in its history. I said when my grandfather was at Ford as an executive, this was in the 50s and 60s, the average aggregated CEO or manager to employee ratio was 20-1. By today, it's 340-1. So there's a lot of greed in the C-suite, but at Amazon, it's like 7,000-1. That's how much they overpay themselves at the expense of their workers. To me, that's not capitalism. That's just feudalism. And to me, these stock market peaks benefit a very small minority of Americans and Canadians. They're mostly getting suckered in. And again, I'll remind that 90% of the wealth in the S&P and the NASDAQ is held by the top 10%. And the smartest ones, if they're smart, will get out. But even if they're stupid and they lose 50% or 60% in a mean reversion, most of those people are wealthy. They're not going to like losing that. They're not going to like inflation. But the middle class or those who have pension funds that are highly invested in the junk bond and credit pools and high yield junk and totally opaque private equity deals, man, they're going to get slammed. And those are the workers, and those are the labor unions, and those are the Main Street folks, are the teachers, and those are the ones that are going to see their retirement account, their IRAs get eclipsed. And those are the ones that I know aren't going to be clients at Von Greyerz, but those are the ones I'm talking to right now. Mm-hmm. Because the really wealthy, the top 10, sort of the top 1%, it's annoying to lose a lot of money. It's annoying to pay taxes. It's annoying to deal with inflation, but they have so many other ways to be fine. They have real estate, they have art, they have farmland, they have diversification. But a pension, a labor union, someone who's got an IRA, if this thing mean reverts 60 or 70% like it did in the Nikkei in 89, that still never recovered its highs, and you're 70 years old and you lose 30, 40, 50% of your IRA, again, these aren't people that I'm trying to sell to. They're not going to make our minimums at Von Greyerz. So I'm not selling my book. I'm telling you what I think. And I would ask people to question me absolutely all day long. Go to your advisor, but listen to the smartest guys in the bond market. Listen to the smartest guys in equities. They want to sell you stocks and bonds. But even Gundlach and Jeremy Grantham, they're not buying right now. And if they do, they're doing it very carefully. So if they're careful and they're worried, imagine what your pension fund managers, the junior varsity, the C- students in the financial world, they're just buying and buying whatever gets thrown at them. They don't have the due diligence and the sophistication. They are absolutely going to put you at risk. And they're going to give you that 60, 40, 70, 30 stock bond portfolio that's highly correlated. And if we have a mean reversion, some will say we won't, I think we will, you're going to get real pain. And it won't be a V-shaped recovery. And the only way it would be a V-shaped recovery is if the Fed put in another, like they did in 2000, print $4.5 trillion in a year to get that market back up. But if they do that and you're up 20% instead of down 60, you're going to be measuring that gain in a dollar that's neutered, and it's going to be debased to the point where you're still getting nowhere. So I think it's a lose-lose until we have a real recession, real austerity, but no politician will admit that, and certainly no banker will admit that.
Mm-hmm. Matt, I'd like to kind of wrap on that note. Is there anything that you'd like to leave our listeners to think about before we do?
Well, again, I want to put myself in the shoes of any listener. I really do, because I'm past the point in my life where I'm trying to sell you. I really am. I'm past that point. We're going to be fine at Von Greyerz because there's always wealthy people buying gold. what I want people, 99% who are listening to this, who are cynical and have heard it all and they don't trust me or anyone else, totally get it. As Rick Rule said recently, I said in another interview, the best investment you can make is in yourself. I keep saying that. Inform yourself, but that's going to take more than 1 or 2 YouTube videos. It's going to certainly take more than some shorts and a couple tweets from left, right, or center. Inform yourself on the history of money. Inform yourself on market mean reversion. Inform yourself on bond risk. Inform yourself on how narrow this equity market is. Inform yourself on the historical value of precious metals versus fiat money. Inform yourself on Bitcoin, but don't believe Bitcoin, don't believe gold, don't believe the bulls, and don't believe the bears. Get your own opinion. And I really mean it. I could be wrong on a lot of things. Brent Johnson could be wrong. Luke Groman could be wrong. We could all be wrong. Grant Williams has said this many times. He's an advisor. Ronnie Sturfula, very smart guys. We could be wrong on a lot of things, but I don't think we're wrong on this thing. And again, I've been in debates about the DXY with Brent Johnson. I've seen Larry Leopard, fighting with Peter Schiff on Bitcoin. Whether you're fighting Bitcoin versus gold or strong dollar versus weak dollar, what do we all agree? The dollar is getting weaker, gold's getting higher. We all agree that at some point. And so that gives me some comfort. But again, my advice to everyone is take someone who thinks gold is a complete joke and listen very carefully to that person. Take a few people like me who think gold is an obvious no-brainer and listen to that person, and then do some independent reading. Go out there on the internet. There's plenty of guys that say markets are going to double. There are more that are going to say it's going to. So again, no one really knows, because I can make a case for the markets go up on pure liquidity. But again, you got to understand what's the cost of that. If the markets rip higher for the next 5 years, that means your dollar is going to be debased. There's no other way. So you can look at the bull and bear case, the inflation deflation case, strong DXY, weak DXY, Bitcoin to the moon, Bitcoin to zero, gold up, gold down. You can look at them all, but you'll find that most of us, including the stock and bond jocks who really understand money, they're buying gold, and they're buying real assets. They're buying real estate, not necessarily commercial real estate or houses in Palm Beach. They're buying farmland. They're stacking physical gold. They're looking at other commodities. They're looking at copper. They're looking at palladium. They're looking at platinum. They're looking at what Ronnie Sturfula calls the commodity super cycle, which moves inversely to the stock super cycle. You got to play where the hockey puck is headed, not where it's sitting right now. And you got to have an investment span that's greater than 90 days. If you're an investor, if you're a speculator, you're a different breed. Nothing wrong with that. Then that's not the audience for us. That's not the audience. Nothing wrong with it. If you can track technicals and you're good luck. There's money to be made in that. But most people aren't that, and they give their money to people who say they are, and they end up losing it. So, but avoid those private equity deals. Avoid those empty, credit pools. Avoid those Roman numerals. If you're from the wealthier side of the street and you got that guy at Bank X telling you about private equity Roman numeral 12 through 14, be very skeptical, please. And don't save in fiat money, even if it's the strongest currency relative to the others. Don't save in it. Think of that shoebox in 1920. $5,000 won't buy you a house 100 years later. 250 gold coins will buy you the same house 100 years from now or 100 years ago. And I think that is so simple, and so be cynics will make up a reason why that's not true either, that Bitcoin will do better than that. But think commonsensically. And that's really how, despite all the complexity and the lingo and the acronyms of Wall Street and all its wonky talk, it's just money losing value every day. And it has been since we got off the gold standard. And we're a country far beyond saving and debt. So we will debase our currency like every country in history to get out of debt, whether it's Argentina today, whether it's Yugoslavia in the 90s, whether it's the Weimar Republic, or whether it's France in the 1780s, ancient Rome to China. This is nothing new. It's hard to imagine that the land with the flag on Iwo Jima got that stupid, but they did, and they are. And that won't be the end of America. It'll just be a different America.
Matt, I want to thank you very much for your time and your perspective today. We always have such an interesting and complex conversation. Of course, for anybody that wants to read more of Matt's work, you put out quite a few articles over at goldswitzerland.com. And of course, that's all available on Twitter as well, at goldswitzerland. Matt, thanks so much for your time today. Really appreciate it.
Always a pleasure, Tom. Really, always a pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.